Welcome to Trading Analysis. This is Lesson 2 of Module 1 in our Trading Fundamentals course, and today we're covering one of the biggest mindset shifts every trader needs to understand: decision quality versus outcome quality. In the previous lesson, we learned that trading is a probability game, not a prediction game, and that successful traders think in large sample sizes instead of obsessing over individual trades. Now we're going to build on that idea, because one of the biggest mistakes traders make is believing that every winning trade was a good decision, and every losing trade was a bad one. The problem? That is not how trading works. In fact, some of the best trades you will ever take might lose money, and some of the worst trades you will ever take might make money. Let me show you why. Imagine two traders. Trader A spends 30 minutes analyzing a setup, checks the trend, calibration risk, waits for confirmation, follows every rule, then enters the trade, and loses. Trader B wakes up late, opens a chart, sees a candle moving, clicks buy because it feels strong. No analysis, no plan, no stop loss, nothing, and somehow makes money. Now let me ask you, which trader made the better decision? Most beginners instantly point to Trader B. Why? Because he made money. But that answer is exactly why so many traders stay stuck. Most traders unknowingly create a dangerous rule. Winning equals good. Losing equals bad. Simple, except it isn't. Think about basketball. A player throws up a terrible half-court shot. The ball bounces around and somehow goes in. Did he make a good decision? No, he got lucky. Now imagine another player takes a perfect shot. Great form, great timing, everything right, and it misses. Did he make a bad decision? Of course not. The process was good. The outcome was unfortunate. Trading works exactly the same way, and this is where traders accidentally sabotage themselves. They take a terrible trade, no plan, no discipline, no risk management, and it wins. Now their brain says, "See, I knew it would work." So they repeat the same behavior again and again, until eventually the market sends them a very expensive lesson. Professional traders understand something most beginners do not. They cannot control outcomes, but they can control decisions. They cannot control what the market does next, but they can control their preparation, their risk management, and their execution. That is why professionals review process, not profit and loss. Because profit and loss can lie, process rarely does. After every trade, ask yourself one question. If I could go back in time and take this trade again, knowing only what I knew when I entered, would I still take it? If the answer is yes, it was probably a good trade, even if it lost money. If the answer is no, it was probably a bad trade, even if it made money. If there is one thing I want you to remember from this lesson, it is this: a winning trade is not always a good trade, and a losing trade is not always a bad trade. Judge your decisions, not your outcomes, because outcomes are influenced by randomness. Decisions are what create consistency, and consistency is what creates long-term success. In the next lesson, we're going to explore the probabilistic mindset and detachment, and learn how professional traders stay calm, objective, and disciplined, even when the market doesn't go their way. I'll see you in the next lesson.
Goodbye!